Welcome to the channel Money Management. In this channel, we are committed to share knowledge about money in short videos. So in this video, we are going to talk about EPF and also discuss about the new VPF rules, which are there especially after the budget announcement made in the financial year 2021-22 budget. So in the union budget, we understand the new tax rules are there for VPF or PF. Let us understand PF and VPF first. Almost everybody knows about EPF, Employee Provident Fund, commonly known as PF. Many people are also aware of the PPF. We have also made a video over the PPF. Link of the same is given below. If you have not invested in PPF or you have some doubts about PPF, please go through the PPF video to have a better understanding of the same. In this video, however, we are discussing about another type of contribution into our company's PF account known as VPF, which is Voluntary Provident Fund. Any contribution made towards the VPF goes into your EPF account only, with a difference that only you as an employee can make the contribution. Unlike EPF, your employer is not liable to make the contribution. The VPF is not very famous among the people due to the reason that if employee increases the contribution in VPF, his on-hand salary becomes less on account of VPF deduction. The lesser on-hand salary on one way demotivates the employee, and another thing is that circulation of money in the market becomes less, thus stopping the rotation of the money. Generally, people are not knowing about VPF. Neither companies nor government advertise VPF, further making it less known and less popular. PF has many advantages. The scheme is very flexible in the means that you can withdraw amount as per the permissible limits within the guidelines of government issued for PF. The contributions made under the VPF are, however, not very flexible. Usually, whenever an employee wishes to increase contribution by the way of VPF, he has to confirm the same in terms of percentage of basic salary or in terms of amount, and the company start deducting the same and adds towards the PF account in form of VPF contribution. Usually, the company takes this from employees once a year and start deducting the amount towards the end of the year. The returns received are again non-taxable under EEE category. Also, PF is usually having a higher interest rate than PPF. You may please check the details of VPF from your company and start investing. You may also fix a certain percentage of your saving target into VPF so that you can enjoy still the flexibility. Often due to long-term investment, people are hesitant towards contribution in VPF. I would like to use the employees. Suppose an employee is earning 1 lakh rupees as salary with an on-hand of 70,000 rupees per month. Now his salary got increased by 10% to 1.1 lakh per month, and on-hand increases to 79,000 rupees per month. Based on his calculations, he is still comfortable with an amount of 70,000 per month in hand every month. Now, he can ask his employer to increase the contribution of rupees 9,000 per month so that his VPF, or in other words, PF amount, keeps on increasing. Whether there is an increase in salary or employee is able to earn through other sources like interest income or any passive or active income source, he can further increase the VPF amount to make it a large corpus. There are definitely other benefits of VPF in addition to higher rate of interest and flexibility to increase and decrease the amount. The PF account is completely transferable whenever you change a job, which means that the VPF contribution will automatically get transferred. Being an absolutely safe government scheme, there are very rare chance of failure of the scheme. Here, I would again emphasize that though I am very sure that VPF is a better scheme than most of the government schemes, and you may see many videos and details on Google comparing VPF and PPF, but you must open the PPF account as stated in my other video. Link of that video is also given in the description. The major reason is that PPF is additional saving, tax-free with great interest, and can be opened to other members of the family who are not in job. Now, I would like to talk about the new VPF taxation rules proposed in the budget 2021-22. We would like to understand that what is the rules and why such rules are proposed. It has been observed that the interest earned on the contribution above 2.5 lakhs per month in EPF will be considered as taxable. Government has actually made the EPF as high interest yield and completely non-taxable under EEE scheme to help and support the maximum people in the country to accumulate some amount of money for their future needs and post-retirement life. While government intends to give the benefit to the mass, it has been observed that there are people who are making very high amount of contribution and taking the tax benefits along with high interest yields. If same amount has been invested into other taxable instruments, government must have earned on account of that interest being taxable and also giving a lesser interest to the investors. It has been observed that in some of the account even accumulated amount is more than 50 crore rupees. Looking into all this and with an intention to tax the HNIs, high net individuals, government has proposed to tax the interest portion earned on the contribution above 2.5 lakh rupees in a year. So let us discuss what we should do after these tax rules. All the investments here, we are talking on the annual basis in a financial year. On PF front, non-taxable interest can be earned on a contribution of 2.5 lakhs in EPF and 1.5 lakh rupees in PPF per annum. Interest earned on EPF has always been historically better than PPF and is expected to be so in future also. I would recommend here that based on the investment potential, one should invest in EPF first up to rupees 2.5 lakhs, then PPF 1.5 lakhs in the name of each member of the in the family based on eligibility, and thereafter any money more than that can be invested in EPF through VPF contribution. Let us discuss the reason of the same. Interest as of now in EPF is 8.5%, PPF is 7.1%. Now naturally one would like to invest in high interest yield, so EPF is better than PPF. Fixed deposits are contributing around 5%. If we are investing the further amount in EPF, we would be getting after tax interest of 5.8, even if we are in a bracket of 30% tax. This 5.8 post tax return is very difficult to find in other investment instruments. Looking into the same, I would recommend to make investment like this: EPF 2.5 lakhs, PPF 1.5 lakhs, then EPF through VPF further amounts as desired. Here once again I would like to remind you not to keep all the eggs in one basket and do the necessary diversification of your instruments and portfolio. Also, please take help of your investment consultant further before investing. So let us understand our position of investment and taxation over new PF rule and take an action immediately. Thank you. So thanks for watching our video. If you like the video, please press the bell icon and please subscribe the channel. Thank you.